Yes, welcome back to our next class that I promised to follow after we had considered on accounting or the accounting on retirement of a partner. We had considered the first method, that is on what we should be doing when maybe we have a retiring partner and yet we have some goodwill with us. We looked on how we should treat goodwill. And now in this class, we are going to look on what happens when we have a retiring partner, yet we have some assets and liabilities that ought to be revalued. That is why we have it as a second method, still on the same title, retirement of a partner. Let's say that upon retirement of the partner, partners may agree to revalue the existing assets and liabilities before commencement of the book value of existing assets and liabilities to determine whether their book values properly reflect their values. We say that any gain or loss on revaluation on asset must be shared by the existing partners, including the retiring one, according to profit and loss sharing ratio. This is to mean that an existing or the existing partner or the retiring partner have the right, if maybe agreed, to share on the profit and losses that may arise after revaluing the asset and liabilities that was existing into the in business when he or she was an active partner, that is before the retirement. We say that the gains are credited to the partner's capital account while the losses are debited accordingly. What do we mean? We mean that as we said about the goodwill, remember when there is some capital that was introduced to the partners at the very start of the business. Now, when the goodwill, the reputation of the business was realized, we said that these are in other ones like the profit arising from the business, and it ought to be credited or to be handed to their initial capital to increase their capital that they can claim as their own or as their equity, while maybe dissolving the partnership. We say that for the purposes of revaluation and establishment of gains or losses, the valuation account now is created. This is the account that is created because we are revaluing assets and liabilities, and this account is of good importance and created. We say that increases in asset value are credited to the revaluation account and debited to the respective asset account and vice versa. When we realize an increase in asset, we appreciate that increase by crediting it to the revaluation account and debiting it to the respective asset account. Let's continue. Let's have an example so that we can understand more on revaluation of assets and liabilities. We have these three partners, that is C, D, and E, are partners sharing profit and loss in the ratio a half is to a third is to a sixth, respectively, not the ones respectively. This means that C is receiving a half of the total, D is receiving at the end of the total, and he is receiving a sixth of the total. The balance sheet as at 31st December 2020 was as follows. Let's start the debit side. We have the details and the amount. We had bank balance of 2,500. Debtors into bracket less provision of 500. We had 15,500. You have inventories of 25,000. Furniture 8,000. Machinery that 5,000. Buildings 45,000. On the credit side, we have creditors 19,000, accounts payable 5,000, reserves 12,000, capital account, that of C was 40,000, that of D was 30,000 and that was A was 25,000. The balancing figure on both sides was 131,000. Let's proceed. We have an additional information. These are very important information to look onto since it gives us further breakdown of what maybe will be happening on the balances that we have seen in the balance sheet. We have been told that D retired on the same date and the following was agreed. Roman 1, machinery and furniture to be depreciated by 10% and 15% respectively. Inventories and buildings to be appreciated by 20% and 10% respectively. Provision for bad debt to be increased by 1,950. A contingent liability of 1,650 initially omitted to be included. Goodwill was valued at 18,000 and they was to share. The remaining partners are to be subsequently share the profit and loss in the ratio 3:5, 2:5, respectively to C and A. Before we proceed to what we are required to do, I would like you to note better on some ones, like depreciating, that is losing of value, that will automatically result to a loss. Appreciation, that is increasing in value, which will automatically result to a profit. And some other things that will be realizing as we proceed. Now, we are required to prepare A, revaluation account, B, partners capital account showing how much is payable today, and lastly, C, the new balance sheet. Let's continue and see how we approach to such a question. Solution. We have our working with us. We have working one that we want to work on the very first addition information that is concerning machinery. We've been told that machinery depreciated by 10%. What is 10% of that 5,000? With your calculators, we can conclude it is 3,500. Furniture also depreciated by, so let's finish on the issue concerning the machinery. So after machinery depreciating by that 500, the debit should hit the revaluation account with an amount of that 5,000 and a credit it machinery account with that 500 or 3,500. Working too about the furniture. We've been told that furniture also depreciated at a rate of 15%. What is 15% of 100? With your calculator, I think we can conclude is 1,200. So how are we going to trace this 1,200? The debit will hit the revaluation account with 1,200 and credit will hit the furniture account with 1,200. About inventories. We've been told that inventory is appreciated with 20%. What is 20% of 25,000? We can conclude with your calculator that it is 5,000. Where is this 5,000? Where will this 5,000 be recorded? The debit will hit the inventories account and the credit will hit the provision for bad debt account with 5,000. On the fourth working, we've been told that buildings appreciated with 10%. What is 10% of 5,000? We can conclude with your calculator, it is 4,500. Where will these 4,500 be recorded? The debit should hit the buildings account with 4,500 and credit should hit the valuation account with 4,500. or 4,500. Working 5, we have the provision of bad debt. We say that we have been told that there was a provision of bad debt, which of 1,950. Where will these 1,950 be recorded? The debit should eat the revaluation account, and the credit should eat the provision for bad debt account with 1,950 accordingly. Working 6, we have contingent liability of all amounting to 1,650. Where will this contingent liability be recorded? Debit, or the amount will hit or will be debited on the evaluation account 1,650, and the credit will hit the contingent liability with 1,650. Working 7, about the goodwill, you debit the goodwill account and you credit partners capital account accordingly. Let's now consider on the revaluation account. As we've discussed about the working, you debit the machinery account with 3,500. I remember to show the working along the part all in details. So let's start with on the debit side of the revaluation account. We debit machinery with 3,500. We debit furniture with amount 1,200. We debit provision for bad debt with 1,950. We debit contingent liability with 1,650. And coming on the credit side, we credit inventories with an amount of 5,000 and buildings with an amount of 4,500. Comparing the two sides, you realize on the credit side we have a total of 9,500. The credit side is greater with an amount of, the credit side is greater than the debit side, as we can see, as we can consider the revaluation account with an amount of 1,200. Now the question arises, how are we going to treat or to record this 1,200? And before that, what does 1,200 represent? I say that 1,200 represent again on revaluation. Why? Because simply when the credit side balance, when the totals in credit side exceed the totals in debit side, you automatically realize that we have a gain on revaluation. When the debit side exceeds the totals in credit side, we realize we have a loss on revaluation. What will happen to the gain on revaluation? We'll share it accordingly. And even if it was a loss, we would have shared it accordingly or distribute it accordingly to the partners. That is according to their profit sharing ratio. So since it is again, we reckon it on the debit side. That is, we reckon or we hand capital, or we hand some capital account to see. That is a half of 1,200, which is 600. That is a third of 1,200, which is 400. And lastly, a sixth of 1,200, that is 200. We hand it to a partner named A. You realize that the balancing figure is standing at 9,500 on both credit and debit side. Let's continue. You have to note that we have the 1,200 is again, as I've said, and should be shared among the partners in the ratio half is to a than is to a fourth. That is the first note better. And we have shared it. That is, we have shared 1,200 accordingly. And we have debited it in the valuation account. So as the balancing or the balancing figure could balance at 9,400 on each side. Another note better is that a contingent liability is a liability which is not materialized. That is, it is probable to occur. That means that the hand aversion, the hand and the foreshadowed that something might occur, and that something or that they predicted that some liability might be incurred or might be due by then. And in simple terms, by the time this partner D was retiring, a contingent liability was confirmed. That is of 1,200. Another last note better is that provision for bad debt is a liability, though not direct. That is, it's a credit balance carried down. So our second question was requiring us to structure all, to extract a capital account. What are we requiring before extracting the capital account? First of all, we have to share the goodwill. And we've been told that the goodwill amounted to what? To 18,000. And we'll share using the profit sharing issue. That is a half is to a than is to a sixth to C, D, and he respectively. So you realize a half of 18,000 is 9,000. That will be credited to C's account. This account to be credited with a amount of 18,000, that is 6,000, and his account to be credited with a 2,000, which is a sixth of 18,000. You realize we start on the debit. Well, let's start on capital account. Let's start considering on the credit side. We have the balance brought down. These were the initial capital they had in their business. We have C having 40,000, D having 30,000, and he having 25,000. Goodwill shared is the goodwill that we have just worked on our working on top there. Goodwill shared by D is 9,000, by C is 9,000, by D is 6,000, and by he is 3,000. Nothing that we have is about the reserve. When you remember about our, when you recall what we had in our initial balance sheet, we had the reserves of 12,000. So we'll share the reserve among the partners. We'll share according to their profit and sharing ratio. So half of 12,000 is 6,000 will be received by C. A round of 12,000 is 4,000, which will be received by D, and a sixth of 12,000 is 2,000, which will be received by A. Nothing that they have, you realize that there was a profit on the valuation or a gain on valuation. We should earn that gain to their capital. That's why we said we'll credit their capital account. We'll credit C's capital account with 600, D's account with 400, and E's account with 200, as we had worked it out from the previous illustration on the valuation. You can see capital account of A, C was 600, of D 400, and of A 200. So since it was again, we have to reckon it or to credit it on their capital account. On the debit side, we have the goodwill written off. On the lesson concerning goodwill, we learned on how to write goodwill. You just write the goodwill using the new profit sharing ratio of the remaining or of the now the remaining partners. And they agreed, as the question and told us, they agreed to share the goodwill. That is on addition information, Roman 6, as I've indicated. The remaining partners are to subsequently share the profit and loss in the ratio 3:5, 2:5. So that is the ratio that we are using to calculate their goodwill or trade off the goodwill. And you realize you will receive 305 times goodwill was realized of 18,000. So 3,000 of the 305 of 18,000 is 10,800, and 205 of 18,000 is 7,200. Some will ask, where have you not included anything? Where have you written off the goodwill without indicating anything today or allocating anything today? This is because D have shared what was, this was because D is no more her partner in this new partnership. So we don't write, we don't indicate anything, or we don't include him while writing off the goodwill. Then we have the account payable or the bank account payable today. This is the amount on the credit side that was due today. And you can see when we hand everything that D required from the partnership, D and the balance brought down of 30,000, goodwill shared 6,000, reserves 4,000, valuation gain 400, and the total is 40,000, 40,400. So D is in need of 40,400 so as he can exit the business or he can exit the partnership by retiring. So the account payable today is totaling to 40,000 to 40,400. Then we have the balance carried down to C and E. So we'll just record, we just balance. We just consider both the debit side and the credit side, and we see the balances so that both accounts should balance off. Let's start with C on the credit side. When you want 40,000 plus 9,000 plus 6,000 plus 600 totals to 55,600. Yet on debit side, C have only 10,800. So we'll carry down an amount of 44,800 so as the balancing figure as C is concerned will be 55,600. About D will just balance off with the 40,400. About here, you realize on the credit side, we have 25,000 as the balance brought down, 3,000 as the goodwill shared, 2,000 as the reserves, 200 as the revaluation, gain on revaluation. Total is 30,200. So, and on the debit side, we have only 7,200. So the difference is 23,000, which is credited to credit, which is carried down to here on the debit side, so as the balancing figure should be 30,200. Hope that is understood. Let's continue. We have now the third issue that is concerning the post-retirement balance sheet. This is the balance sheet that we should extract after now the retirement. You realize about the asset, we end the bank balance of 2,500 or 2,500. The bank balance will remain. The debtors, we had debtors of 15,500, but now we have the provision for bad debt was raised to 1,950 or 1,950. So we'll just subtract these 1,950 from the debtors, and the remaining amount is 13,550. About the inventories, remember the inventories are appreciated with 5,000. So we hand that 5,000 to 25,000 to have our total inventories amount on the new or the post-retirement balance sheet being that 1,000. Furniture, remember furniture depreciated with 1,200. So we subtract the amount that it lose value with, that is 1200, and we get the amount, the new amount to be 6,800. Machinery also depreciated with 3,500, as we have to subtract the 3,500 from that 5,000 to remain with that 1,500. Buildings appreciated with 4,500, hence we have to hand the 4,500 to have the total of 49,500. On the credit side, we have creditors. Creditors remained an amount of 19,000. We have account payable, that is of 5,000. We have contingent liability was created of 1,650. We have payable to D, that's a new or a special liability now to us, because D should be paid 40,400. And we have the capital account now of C, with the balance that we carried down here from the capital account. Then on the debit side, look very careful. The balance that we carried down, D 44,800, 823,000, those are the capital, the new capital account to C and D, and as we should record them as on the side of the credit side, because it's their capital to the business, as we reckon 44,800 to C and 23,000 to he, and the balancing figure becomes 133,850 on both sides. Hope we've understood. I urge you to kindly subscribe, share, and comment on this channel, so as you can continue receiving more and more concerning accounting and any other issue. As example, this is a topic by the name financial reporting. We'll be tackling about taxation. We'll be tackling on almost every topic in business course, especially for those pursuing bachelor's in commerce, any option, finance, year 1 and year 2. But for accounting, we'll continue from continuing from where you started to the last very topic. Kindly subscribe. Thank you as you look upon to attending to the next class that will be talking about accounting upon the death of a partner. Thank you, and much welcome.